This conference will now be recorded.
My name is Andrew Smith. I'll be your moderator for this morning's session. This webinar is an event of the New Brunswick Association of Planners of the Atlantic Planners Institute, so also in conjunction with Watson Associates and the City of Moncton. So normally these sessions would be in-person planners and clients events put off by the local continuous professional learning committee. However, with COVID-19, we've moved to obviously an online format or planners and coffee. So I suppose if you're not bound by HR policy, it theoretically could be planners and clients for you this Monday morning, but I think most of us, it's going to be coffee or tea or water. So joking aside, this has allowed us to broaden the invitation and participation across other organizations. So we do have other professionals on the line, so namely members of the New Brunswick Development Officers Association and Association of Municipal Administrators of New Brunswick. So I do welcome these folks and any other participants that may have stumbled upon this session. Please note that new CPL events are regularly posted under the events section of the API website. So the next event is actually on September 9th and is a presentation on the Atlantic data stream by Emma Waddy, Director of the Atlantic Water Network. So I'll post a link to this event via the chat to all participants. Before we get started, a few housekeeping items. Please remember to turn off your microphones throughout the session. We will be auto muting along the way, but just in case, it would be appreciated to avoid some of the background noise. So today's webinar format will consist of two main parts. Part one being the higher level development charges 101, which will be presented by Gary Scanlon, and then part two focusing on a specific case study in Moncton, New Brunswick, presented by Bill Budd. So we've allotted 10 minutes midway and 10 minutes at the end of the presentation for fielding questions. So you can use the chat function to ask questions directly to me. Use the drop-down presenter to send me messages, and we'll put them in a queue, and hopefully we can answer a few, as I mentioned, midway and at the end. So without further ado, I'll introduce today's presenters. So first, we have Gary Scanlon with Watson Associates. He's a managing partner and director of municipal finance with the company. So Gary has 40 years in management and consulting. Gary's worked with over 150 municipalities in the private sector, or rather municipalities and with private sector clients across Canada. He's worked with over 70 municipalities to help establish water and wastewater rate structures. Gary's also authored several articles on development charges and often appears before provincial and appeal tribunal boards. So secondly, we have Bill Budd of the City of Moncton. He's the Director of Planning and Building Services. So he oversees the planning and building services under the newly formed Sustainable Growth and Development Services. He's the former Executive Director of the Greater Moncton District Planning Commission, also worked with various levels of government in Manitoba, and is the former President of the Atlantic Planners Institute, and also the former member of the Council of the Canadian Institute of Planners. So I'm going to just hand it over to Gary here to head straight into part one, Development Charges 101.
Thank you, Andrew. It's appreciated. I'm very happy to be here today. I take it, Andrew, just technically, I'll just indicate to you to flip the slides and you'll advance it forward for me.
Correct.
Okay, perfect. Excellent. So once again, pleasure to be here. So we, our firm has worked with development charges since 1982. And in fact, in Ontario, we've had development charges for 60 years. So we've gone through, originally it was under the Planning Act. It evolved. We had numerous board hearings to help shape the methodology and the definition of the charges. And since 1989, we've had an actual piece of legislation called the Development Charges Act. Personally, I've worked in New Brunswick, Alberta, Manitoba, Regina, Halifax, New Brunswick now, doing DC work. And probably the Ontario one is the most detailed and robust. That doesn't necessarily say that a lot of the methodologies and approaches aren't dissimilar across, but it's just we've thrown more, I guess, words and language around the what's to do and how's to do. So I'll talk about cases right across Canada, give you some insights on how this is carried out. This is the kind of the main topics we're going to talk about. We'll talk about the general methodology, and as I say, there's a commonality right across Canada on how to approach this. When we're doing development charges, you generally have to distinguish between the more very localized costs, say within a subdivision, the internal roads, water mains, sewers, street lights type of thing. That's what many municipalities define as a local service. And then if you go outside of the individual subdivision, then we start to move into areas where development charges may or may not apply. So to doing cost sharing or recovering these broader costs the municipality may construct. So we'll talk a little bit about that. There's always policy considerations. What situations are we going to impose the charge? Are we going to adjust the charge annually for indexing? Cost of money type of thing. We'll talk about growth forecasts because there's several different approaches to how these calculations are done across Canada. So we'll talk a bit about that. There's pros and cons to them, but basically it's to the pleasure of the municipality or really the province on how we do them. Talk a little bit about capital costs because obviously that's what we're recovering. And then go to the calculation. So there's other matters to consider, which we'll touch at a very high level and then go into things such as exemptions. Those are in particular, certain times municipalities may not want to charge for places of worship or charities or such. So these are some of the exemptions that councils often consider. Next slide. So really what we're trying to do, what development charges are, in very simple terms, are to recover growth-related costs of infrastructure. And that varies across Canada. I think primarily you'll see that all provinces would allow for water, wastewater, and roads, certainly, and maybe stormwater management costs to be included in almost every circumstance. But then outside of that, it varies. Some municipalities will allow for fire protection or for the recovery of parks and recreation, where other provinces will allow for a full gamut of services. In Ontario, there's about 21 different service categories that we can collect for. If you go out to places like BC, water, wastewater, storm, roads, fire protection, and parkland. And then that's the general service. And then, but if you go into Vancouver, they allow for more of the broader services such as recreation, etc. So depends on the province, and it does change over time. Here you can see within Toronto, as I say, we've evolved to roughly about 21 different services that you can charge for. There's a number of deductions, reductions, so it's not 100% recoverable even if those services are eligible. So in Ontario, we have, as I've noted, these mandatory adjustments. Halifax has traditionally, they started off with water. We actually helped them define the wastewater calculations for Halifax. They were into a major hearing a few years back, so we helped to define the methodology, the approach, how they did the calculations, etc. And we were awarded favorably at the board hearing. It was the water board that was actually approving it. More recently, they've expanded the services, so now they're starting to broaden to be very similar to what you can do in New Brunswick. If we go to the US, you'll find a variety of different approaches and such. They call them impact fees, exactions. They sometimes do specialized development taxes, almost like excise taxes and such. And sometimes they do special district financing. The impact fees are almost like what we do here in Canada, but as I say, they vary similarly as they do across Canada. They'll vary as you go across each individual state. So it's a common practice right throughout North America. So it's nothing that's unique. It's just maybe slightly different approaches, but as we've talked about. The common methodology is really laid out in this very simple schematic. And we always start up at the top with the green area, which is talking about anticipated development. So depending on the nature of the service or the approach of the municipality, we either talk about population growth or employment growth over planning horizons, or we go down a little more granular and we look at actual areas that are going to be built, and we take a look at either the number of acres of res versus non-res, or in certain cases we may look at linear lengths in order to allocate certain costs. But we're always looking at the land area, and resulting from the land area, the amount of growth that'll ultimately arise. As we drop down from looking at that growth or looking at that development area, we start to estimate the need for additional services. Now, that can be different depending on the nature of the service. For example, if you're taking a look at water capacity or sewage capacity, you'd be saying, okay, how many people are going to arise through this and how many employees? A lot of times the engineers take a look at flow calculations based on a certain amount of flow per capita and a certain amount of flow per employment. And that, you know, over a planning horizon would define how big a water treatment plant we need and what do we need to expand. If you're looking at pipes, you're looking at within this area, we're going to get a certain density of growth, and they do their math and their calculation. They say, okay, I need a 12-inch or a 300 millimeter water main to service this area. So they're talking about the need that arises from that development. And if you go down from the purplish color in number 2, and you go down to the dark blue in 4, we move from the servicing needs actually into estimating the capital cost for those individual works. Now, if you look at the little arrow in between 2 and 4 that goes off to the left, you can see that we talk a little bit about local services. So development charges don't recover 100% of all the infrastructure. There's inevitably costs that are the developer's responsibility. So generally within the subdivision, I'm a developer. I got to put in my local water mains, my roads, my sewers, etc. So those are deemed local services. They're costs that I, as a developer, will pay for 100%. But then the development charges normally take care of the costs that are outside of my subdivision, so they're of a broader benefit. And what we try and then do is allocate a proportionate share of that cost to the different types of developments within the area. And in doing so, that's where we move through consideration of some different calculations. As we drop down, we may identify a number of pipes. There may be in our calculations, the first orange box says, well, you know what? If we're talking about water capacity and the engineers do their calculations, they may say, gee, we need a treatment plant that's going to give us 10,000 cubic meters a day. But your existing plant may have 1,000 cubic meters a day. So you would normally recognize what's there as excess capacity. So what can be accommodated through the capacity that's available in the system. So that's normally recognized somewhere in the calculations. The next orange box talks about benefit to existing. So from these particular works, are we benefiting any of the people within that area? So maybe if we're, a good example is if we're extending a pipe to the outer reaches of the municipality, And that particular area right now, the people have their own wells and perhaps septic system. If we're now going to service those existing homes, then we would have to recognize that maybe there's 100 homes there, and we're building services for 1,000 capacity. So 10% would be deducted because we're now going to service those homes. So you have to recognize any benefit that's to an area. Well, also, we may be building water capacity, upgrading capacity, so maybe they have insufficient fire flows. So enhancing the capacity in that area would take care of insufficient fire flows. So there's a number of different measures we look at with this benefit to existing, and it depends on the service and depends on the nature of the servicing. Sorry, can we go back so I can finish the slide? There's the third orange box. Are we going to get any grant subsidies, other contributions from the province or from the federal government? This is important during, we had the Build Canada funding some time back. So we may be seeing that with the COVID-19, some type of stimulus funding. So you'd want to deduct that so you're actually not making money, you're allowing the benefit to inure to all of the different landowners. And then there may be some other deductions that may be specific to the province or to the municipality. We end up with box number 9, a net cost that we would then divide by the residential and non-residential growth, and that's where in 12 we come up with a charge. And depending where you are across Canada, in Ontario predominantly we do it on really on housing units, so low, medium, and high density, and then on the cost per square foot of non-residential building space. But then you go into such as Alberta, and almost all of their calculations are done on a per hectare charge or a per acre charge. And then other places such as Manitoba, you go to Brandon, they've done a bit of a mix of both of it. So, depending on the nature of the development and the legislation, will calculate it slightly different. Now, the other 2 boxes there just talk about, the one on the right-hand side talks about spatial applicability. So you can have a hierarchy of charges where maybe you have very localized charges area, maybe a broader secondary plan area, and maybe a municipal wide. So depending on the service and depending on how you want to approach your calculations, you can have a very narrowed, a broader secondary plan, or even a municipal wide type of charge for the services. On the other side, you can see on the left-hand side, we talk about financing. So if the municipality has to build it, can we add in the cost for interest if we have to debenture to build the infrastructure? Obviously, year to year to year, inflation is going to impact that. So we have to have an approach or a policy to adjust for that. And then, if you've got some money, you're stockpiling it, you want to make sure that the money that you've put into a reserve is earning interest. And as Bill will talk about, all of these matters that are contained within this methodology, we've addressed in their particular case. So next slide, Andrew, please. So in very simple terms, really simple terms, what we're trying to do is identify the cost of infrastructure to allow growth to occur. And then we're going to divide it by the growth in order to come up with the charge. So both on residential and non-residential. Next slide. One of the things you might want to consider is cash flow. That is always very important in our discussions. Is you may want to build the infrastructure, but you should have consideration of how long it's going to take you to recover. And in some instances, we have the developer build it and let them recover the cost. In other instances, the municipality may do it and then seek to recover the costs over time. So your policy should embrace this type of thing. Next. So I talked about local services, and we provided a schematic, And in Moncton's case, and Bill will go through, we've really done a good job, I believe, in differentiating this different hierarchy of costs. So in this particular schematic, we've shown that the very bottom, the small localized water mains and sewers and drains for storm and for roads are the direct developer responsibility. We then move up to the next category where we have these pipes or these pumping stations or whatever that will benefit a broader area. And that could be defined as a secondary plan area. And we will look at the servicing that is needed for all of the developments to proceed. And then there are many municipalities that will look at the blue area, which is the very broad costs. You've got a treatment plant facility for water or wastewater, and you have to storage, for water, and then the major trunks that may move that water from wherever the treatment plant is to wherever the development is. And many municipalities may have a broader charge and may be across the whole municipality for those particular services. So this is something that's important when you're starting to structure your charges, is to identify this hierarchy, because then it makes it far easier to then develop how are we going to allocate these costs across development, how are we going to do all of these different deductions for benefit to existing, etc. Next slide. And this just puts some words to what I've just talked about. What is internal, what's more localized, what's area charges. These are things that you need to consider as part of that hierarchy. You can see that the first bullet talks about quite often internal roads, sewers, water mains, sidewalks, street lights. But then even municipalities in different provinces then start to get into things, well, how about parkland dedication? How about trails? How about bicycle lanes and paths and street lighting? So it can be broadened depending on the municipality and depending on, or the province really, and depending on the services that you can recover. Next slide. And once again, this just summarizes a lot of the different types of services that we can recover. Next. So, as I say, when we're going through and we start this policy consideration, the starting point always has to be, looking at that hierarchy of the servicing, and then start to figure out what's a developer, what's more localized on an area, and what's broader charges. And that helps us calculate the benefiting area. So your bylaw will probably apply in different components to different areas of the municipality. We talked a little bit about benefit to existing, so you must turn your mind to it. Quite often it is looking to the engineers and what are their assumptions when they take a look at these land areas, and what did they take into account as part of their calculations. Imposition of the charge, are you going to do it on a land area basis, so per acre, per hectare? Are you going to do it on built form, or are you going to do some combination thereof? And then lastly, as we've talked about, sometimes councils turn their mind to giving discounts or exemptions to different types of developments. Maybe we want to encourage places of worship, so the municipality will put the money in instead of that particular development. So it's almost a transfer payment from the municipality to cover the cost for those, anything that they're discounting or they're exempting. Next. So the area specific charges, what's the calculation framework? You need to, when we were working with Moncton, and Bill will talk about it, we needed to make sure that we had a policy that would apply across the totality of the municipality, because we were starting with an area specific, but we needed to make sure that as we moved forward and considered different areas, that we had policies that would consistently apply across the whole municipality. So then it wasn't inconsistent when we had one bylaw or one charge being calculated over this part of the city and a different area being calculated in the other side of the city. What are some of the things we need to consider? How do we deal with publicly owned land? So if the municipality owns parkland and there's a road that runs adjacent to the parks, how do we deal with that? What cost do we attribute back to the municipality? And should there be any of these lands that are deducted from any of the calculations? Okay, and then we talked about the discounts, etc. Next slide. Now, the growth forecasts, this is where a lot of times we talk with the municipality. What's the best way that when we move forward that we impose the charges? As I say, in Ontario, they do it on built form. In Alberta, they only do it on acreage. So these are things obviously that we need to start with as part of your policy, and then the growth forecast will fall out from that policy. If you're doing it on built form, we look at population and employment. We look at it over maybe a 20-year planning horizon, or maybe we'll look to build out of the municipal plan. Or sometimes we do it on a service capacity basis because we're calculating for a large treatment plant, and that plant may be oversized because of economies of scale to build a certain size treatment plant, so it actually may have more capacity than what your municipal plan sets out. So once again, very important to start our calculations to look at the development either on a localized basis or across the full municipality. Next slide, Andrew, please. And we talk about, and this is something that's important, we talk about development. We don't necessarily talk about population growth or employment growth. Your municipality may have, from census to census, a zero population growth. But if you take a look at the building activity, you may have been issuing 100 building permits per year. And that means over 10 years, you've got 1,000 building permits. And those permits are going to require water servicing, sewer servicing, potentially roads, parks, etc. So even though your census population isn't showing any difference, when you look at the building activity, you can see that there is development within the municipality, and we need to have costs, or we have costs that are going to be incurred in order to open up those areas. So there's a mindset we have to get out of being population growth as the only form of development, when it's actually looking at what's actually happening on the ground. So what building activities happening, what lands are being brought on for servicing. Next slide. And this just, this is when we go through some of the calculations. We consider demand on one side, so how much building activity has there been, the 100 units per year. We look at the supply side, where is it occurring, how much, what has the municipal plan set out for developments, and quite often we go through some detailed calculations to forecast potential population targets into the future. And if we take a look at the next slide, that often translates into building activity. How many low density, singles and semis, medium density and high density do we anticipate over time? And you can look at that historically. So that's what the 2002 to 2012 is a historic level of activity, averaging in this particular municipality at about 950 units a year. So then we look at the forecast, what's coming through the development process, what's the more localized forecast for building activity, etc. On the non-residential side, which is the next slide, we get into a similar type of thing. Some development occurs as a result of population growth. Quite often your retail, and supply side, supply services follow population growth, and then some of them in institutional as well. And then some of them follow more localized or broader trends. So your non-residential would look at it from this perspective. And if we just look at the next slide, I won't spend much time on it. We're looking at the population, which breaks down into primary, which is your agricultural. There's going to be some work at home, industrial, commercial, institutional, and then some non-fixed place of work. The work at home and the no fixed place of work generally are unique in that they don't directly drive non-residential services to be constructed. No fixed place of work means there's salespeople that are, or truck drivers that are going all over Canada. And the work at home means you really are looking at those as part of your residential, but that's for another day to talk about. Next slide, please. So estimating capital costs, and I always try and remind people that you need to consider all of the costs that are going to be borne by the municipality. If you're building it, you need to consider all costs. And when engineers do their master planning work, water master plan, sewer master plan, roads, and they come up with costs, you need to ask certain questions. Did you include land costs as part of your estimate? Because we're going to have to go out and buy the land. What's the construction cost? Have you just considered materials, or did you consider labor as part of that? There's design and engineering, because that has to be created. There's landscaping, parking, so there's other costs associated with it. Permits, approvals, HST or PST, and then potentially others. So, challenging the engineers to detail all of their assumptions is very important. And over 40 years, I've learned to ask all of these questions to make sure that the charges are actually reflective of what the costs are to build those works. Next slide. Yeah, so the next two slides, I won't go into much detail. They're very similar, but slightly different for water, wastewater, and storm versus the next slide, which is for roads. So I'll leave that with you. You can take a look at it in more detail later. Next slide, please, Andrew. And just to say, when we're doing these, we not only rely on engineering estimates, so those are the master plans or different facility studies, but we use construction cost manuals. Means is you can use right across Canada. There's locational adjustments. Quite often municipalities detail works in insurance policies, so we can take a look at if you're building something new, which kind of is reflective of what you have today, like an arena, for example, in Ontario. We would look at what's the cost of an existing arena to replace. We might use that as part of our cost estimate. PSAB data index, you might go to that or talk to other municipalities. Anyway, there's different sources that we use, and it's just something where you might want to consider it when you're doing your calculations. Next slide. Other matters. So, there's we talked, and this really goes back to that methodology and just puts some additional words to it. We talked about excess capacity. Is there some excess capacity in the system? And unless you historically said we want to recover that cost, it's normally a deduction. As I say, if you've got some excess capacity in the water treatment plant, you may want to recognize it and only charge the developers for the incremental cost of expanding the plant. Next slide. If you're doing a split between residential and non-residential, should there be in your calculations a split on how to differentiate that? Even within, if you're doing a land calculation, maybe when you're talking to the engineers, they do a different costing for an acre of residential versus an acre of non-residential. Quite often non-residential, you need to provide for maximum fire flows for those buildings. So they'll increase the size of the pipes because during a fire event, you need very large pipes to fight warehouse fires or certain types of industries. So you may want to change the cost per acre depending on the nature of the servicing. Stormwater may be varied because the water will run off of commercial industrial lands a lot faster. So that will give rise to unique servicing versus residential that have a lot of grass, and the water might migrate slower. So anyway, these are different considerations that we go through when we're looking at the charge. Next slide, please, Andrew. Benefit to existing, we kind of talked about this. If water and sewer is going into an area that hasn't been serviced at all, then there would be a deduction to recognize them receiving the service. If we're overcoming fire flow deficiencies, there may be other types of things that we may make a deduction for to recognize the benefit arising from that services. Good example is replacement of a water main or a sewer and then upsizing it for development. The replacement means it falls into part of your asset management policies for the municipality. So we need to rationalize that as part of the calculations. Next slide, please, Andrew. Grant subsidies and other contributions. Sometimes they arise, sometimes they're not there. Generally, we don't consider if you use gas tax as a grant or a subsidy in our calculations. Because of the way that that program is structured, you can apply it anywhere towards replacing existing assets. You can apply it to growth-related assets, etc. So we normally don't suggest that that is a deduction for individual services. However, as I say, we may see a new Build Canada coming out after the COVID-19 in order to stimulate development within the areas. And probably that grant program would be something that we would have to make a deduction for. Next slide. Post-period benefit just identifies that if we've oversized something consciously, like if we need a certain amount of water treatment capacity, but we built it bigger, you'd obviously need to make a deduction so that the people that are going to grow in this time horizon aren't subsidizing people later on by paying for their cost of the treatment plant. So they're depending on whether it's roads, whether it's water, whether it's sewer, there are different approaches, and whether it's a treatment plant versus a pipe, there are different approaches to allocating a post-period benefit or a benefit that's outside the development area. If you're doing a very localized type of charge, we may look to take a portion of that cost and recover it from another area. And that would be similar. That would be outside of the growth within that, that particular area charge. We're getting close to the end of my presentation. I think I'm on time. Next slide, please. So when we're doing calculations, and this is where we identify the projects, and that's what you see on the left-hand side. We try and identify timing because, you know, cash flow matters. This is a broader charge. So this isn't a very localized, this is more of a broader. So we've got the cost estimate, we've got the timing of the infrastructure, and then you can see that for one of the projects, we did push some of the cost into the outside the planning horizon. It'll still be growth related, but we're not going to charge it to the people that are going to grow within this particular time horizon, which looks to be out to 2031. We then have a net capital cost, and you can see we have further deductions for this particular municipality. We've deducted benefit to existing and from grants, and then we ended up with a net amount that we'll recover from the development charge. Now from that column that says total, if you're doing it on a per acre basis, then most likely you'll take that number and then divide it by the acres that benefit. In this particular case, this is an Ontario example where we're going to allocate the cost to residential development based on built form, and then the non-residential, same thing on a built form. So we've had to segregate the costs and then do the calculations slightly differently. And then next slide. And then exemptions, just quickly. This is something that you'll want to talk to your council when they're developing the policy. Is there any type of exemption that we want to include? But keep in mind, every time you exempt, the charges are not like licensing fees or such. These are to recover the cost of infrastructure. So if you exempt somebody and say, okay, you should be paying $100,000, but our policy says you don't have to, then the municipality has to kick in the $100,000 for that development that they've delayed. So you need to be mindful of it, that they're great policies if you want to encourage something, but with development charges, there's a cost associated with it, which the municipality has to pay. Next slide. And these are just quite often ones that we talk about, places of worship. Sometimes, especially with things like roads and such, there may be farms, farm operations that'll benefit from it. Industrial development, sometimes you want to encourage industrial. Do you want to charge the downtowns or infill development, brownfield redevelopment, hospitals, university, colleges, nonprofit housing? So those are just some to think about when you're developing your policy. And then last slide, timing of collection is important. You want to collect it when the building permit's issued, or when you're approving the subdivision or the site plan. If there's a sizable investment, especially with water and sewer, you have to invest in that infrastructure before development proceeds. So you may want to collect it earlier than later. So collecting it at subdivision would be best for cash flow. Later might be something you consider because you want to benefit certain types of development. So maybe high density, there's a lot of upfront costs before they get any money. So you might want to get into more delayed payment arrangements. Once again, these are policies for you to consider for your individual municipality. And then the next slide just talks about very simple. We've talked about the planning on the top, the different stages of planning, maybe when you do your municipal plans or secondary plans. And then as you move through, you're going to have draft approval, subdivision approval, and then building permit, and ultimately occupancy. But you can see with the infrastructure that, before the subdivision gets full approval, you have to have the treatment, you have to have the capacity available for them. So that means that the municipality is investing very early. The distribution can be constructed maybe slightly at the time or slightly as the development's occurring. But once again, you have to have that full servicing in place before there's occupancy. And then you can see the line for localized services. So all this is meant to do is just from a graphic perspective, kind of keep in mind the timing of the infrastructure relative to the timing of the individual developments. And I think that's, yeah, I hit the question break. I think I'm 15 minutes over, so I apologize for that.
No worries. We haven't received any questions in the queue. So just a reminder to directly message me, and if you have any thoughts or questions throughout the remainder of the presentation, even for Gary's portion at the end, we'll have a little more time, roughly 15 minutes, if you have any questions in the queue. So we'll move on to the second part of the presentation, case study focusing on Twin Oaks Extension Drive. So I'm going to pass it over to Bill Budd.
Okay, good morning, everyone. It's a pleasure to be joining Gary Scanlon of Watson Associates on this webinar with all his experience with preparing development charge bylaws across Canada. We certainly benefited from that experience, and Gary and his team made it easy for us to pass our first bylaw. So what I'm going to try to cover, you can see some of these points that I'm going to try to go through, and maybe Andrew, you can go to the next slide. So in terms of background, a little bit of background to set the context for why we need certain infrastructure. In the case we're looking at Twin Oaks, the city's municipal plan and regional sustainable transportation plan contain policy objectives for completing a major collector roadway, which entailed connecting Twin Oaks to a roundabout at Ryan and Horseman Road. And this remaining kind of collector roadway was about 700 meters. But it was a major objective to connect this for probably the last 20 years. So this growth-related infrastructure is required to support what we're calling anticipated development in this area, and for example, the province, they contributed to a reserve for a roadway when it built a coal cement school in 2012. So part of this will be deducted from the development charge, which I'll try to explain a little later. The new Community Planning Act provides for development charges, and recently the province brought in development charge regulations, which provides a framework for doing this in New Brunswick. The City of Moncton also recently partnered with the YMCA to construct a new YMCA sort of North End Community Center in 2009, which triggered the need to complete $2.1 million Twin Oaks extension. So you know, when we talk about anticipated development and the estimated need for infrastructure, these were some of the things that triggered that. And so the city initiated this project, its first development charge bylaw, and it's focusing on a local cost sharing approach to recoup its city expenditures for the extension of Twin Oaks. So next slide. So in terms of the city context, the North End is one of the city's fastest growing areas. And if you look at this map, so the yellow areas sort of highlight what we'd call our emerging growth areas inside the city's urban boundary. The blue areas highlight the established areas, and the green areas represent sort of infill and redevelopment areas. You can see sort of the pink areas, the industrial, and our downtown areas, sort of a lighter kind of orange as well. It's interesting to note, since we've brought in this new bylaw, and I'll go over some of the details, we've had requests from other developers across the city to bring in or look at creating area-specific development charges to try to open up some of these areas, the emerging areas. When you look at Moncton, all the easy land has been developed. So to open up some of these emerging areas, we're into dealing with what I'd call new and expanding growth related infrastructure, dealing with intersection improvements, culverts, bridges, watercourse crossings, naturalized approach to stormwater management, trunk sewer upgrades, etc. Next slide, please. So for this case, and this is an easy, I call this Moncton's approach to sort of baby steps to introducing development charges. So we're starting with a sort of what we call a local cost sharing approach for a major collector. There's about 6 landowners affected by this, and the aerial map shows the subject area that we're taking a local cost sharing approach for Twin Oaks extension, and you can sort of see it kind of roughly cleared out and how it will come into the roundabout. what's interesting, you can see Ecole Summit School. When the province wanted to locate a school in this general area, it had to do so by subdividing off sort of a 25-acre lot off a former former farm in this area. And when you look at the municipal plan, we had a dedicated future road going through here. So at that time, we weren't ready to build this road, and the province wasn't going to do it on its own, but it had agreed to provide a contribution to cover its portion of the cost. So that was put into reserve, and it becomes a deduction in our development charge bylaw, which I'll try to illustrate a little bit later. We go to the next slide. This is taken from our actual development charge bylaw, and it's a schedule for the Twin Oaks development charge bylaw. And when you look at development charge bylaws across Canada, they have various schedules for different areas. So I'm going to talk about the principles framework, but when you do a development charge bylaw, you create an overall bylaw and you set out how you're going to approach it, whether it's local cost sharing or area specific or citywide, and then you apply it to different contexts. So in this context, we're starting with just this area. And again, it just shows you the area that we're trying to recover $2.1 million associated with sewer, water, stormwater, road, sidewalk, and walking trail costs through this collector roadway. So if you can go to the next slide. So we're dealing with timeline. This sort of reflects the legislative process. We awarded the RFP to Watson and Associates last spring in 2019. And sort of through June to October, we did a lot of background work. There's an actual background study, and we got into trying to define, what are the costs, what are the benefits, how do we allocate cost recovery to the benefits. And through that process, we met with a lot of landowners and then introduced it to council. It went to the Planning Advisory Committee through the public hearing and ministerial process. And it's, I believe, the first development charge bylaw registered in Brunswick. So we're very pleased with that. If you go to the next slide, the consultation, I mentioned earlier, the province adopted a development charge regulation to go along with the legislation. And that sort of sets out a framework for how you bring in a development charge bylaw. So you have to go through a fair and reasonable process, and you've got to consult with all affected landowners and the public. And we went through that process fairly comprehensively with the assistance of Watson and Associates. And all through the process, we maintained all our information, our background report, our policy framework, or what I'd call principles framework, and the bylaw were all kept on a consultation website called Let's Chat Mountain. And that was also used to solicit feedback. And we also had pamphlets and Q&A information on that. And through this process, we sent letters to every affected landowner. We had focus groups with them, and we got through the whole process. And it's kind of funny, and Gary may recall this. I'm not sure you get too many applauses at the end of the consultation process, but we had a meeting room filled with builders and property owners, and we got an applause at the end. I guess they see this, they understand that all the easy land has been developed, and they need these kind of tools to help them open up the growth areas. So if we go to the next slide, this is, Gary's covered off a lot of the principles framework, but it's your policy framework, and you use this for council and even setting up what we at the city at the end of the process. We have staff that have developed what we call standard operating procedures or work instructions for how you administer this bylaw, right? And this principle framework sort of outlines how you do that and gives you guidance on how to create a development charge bylaw, how you're going to calculate, go about calculating the charges and dealing with various things like I talk about exemptions, for example. In our downtown, we have we're trying to actually incite development with a downtown financial incentive program. So it doesn't make sense to impose development charges. So our downtown, if we go to a citywide type development charge in the future, probably would be exempt, similar to our industrial parks. We have some very vibrant industrial parks that are Moncton Industrial Development develops. They do all the work, they put in all the services, so we probably would also exempt them as an example of exemption. Just the other thing I'd like to touch on, imposition of charges, land area basis versus built form. And Gary talked about population and built form. So if you think about higher density development, usually has higher population. So when we get into dealing with area specific development charges, which we're actually doing another bylaw in the near future for a neighborhood area, the higher density areas will probably have a different formula because of the increased population in those areas on charges. And so when we're doing an RFP to help us with this bylaw, so when we get into doing the background work, part of that you'll have to determine the benefiting area and how you calculate those charges. And this whole principles document sets us up to do that work, in the future. So then if we go to the next slide, Gary sort of covered this, the hierarchy. And what's interesting, if in the New Brunswick context, when you think about, in each of our municipalities, developers are creating subdivisions. Well, that lower blue area, they're responsible for their own water and sewer and local roads and stormwater and land dedication and such. So they're responsible for generally 100% of the costs. It's when say a developer puts a roadway with water, sewer, and other services down a property line where there's a benefiting property that abuts it, you can get into local cost sharing. And so that's that beige area. The purple area is the area development charge. So if I look at our regional sustainable transportation plan, it outlines an arterial and future collector roadway hierarchy across the city. And we have certain collectors we're trying to establish, and some of those areas have major intersection improvements, bridges and other infrastructure. And so these are all what we call growth related impacts that have to be paid for. And in Moncton's context, if we have about a $200 million infrastructure deficit just to renew water and sewer and aging roadways and other types of infrastructure. So this new tool will help us offset the cost of that infrastructure required for future growth. And then the gray area up top deals with citywide. We're not we've set up, our principal framework has set up that we could use this, but we may not use it for a while. We're taking our baby steps. We're focusing on local cost sharing and the area specific. But for example, this summer, a very hot and dry summer, and I know, you know, the cities sort of asked everyone to turn off their sprinklers, and we could face a situation where, you know, we have drought conditions and we may end up, I'm not saying we will, but we had a blue-green algae breakout or something and we had to do something to the reservoir, a major treatment. We could use this, and if we had to do a treatment upgrade, there would be a benefiting cost to existing residents that may be offset by rate increases, but there also could be a benefiting cost to development. So, but through our background, what I found through Gary and his work with some of the communities across Canada, Brandon had a really good approach to citywide development charges. And you remember the map I showed you, they broke up their map across the city into a, you know, established area, emerging areas, and they determined, I think, they had a need for about $160 million of what I'd call growth-related capital for that anticipated future growth. And then they determined what is the benefit to the existing population and what is the benefit to the future growth. And they I think, Gary, you could correct, it was about a 50-50 split. So they ended up taking that charge and allocating it across the whole city as a citywide charge, and they covered off all their infrastructure in a more comprehensive manner. I would like to see us do that, but we're not ready for that yet. So we're taking our sort of incremental approaches with local cost sharing and area specific approaches. Next slide, please. So some of the other things our principles framework deals with indexing. So the cost of construction goes up every year. So we know what the costs are for Twin Oaks this year, but that cost keeps going up. So to keep pace with inflation, our bylaw allows us to do indexing. So every year we'll do an update to the actual cost. So we may not be able to recover on a charge, you know, until 10 years later, right? Well, that cost has a certain cost today, has a certain cost 10 years from now, and we'll be able to, you know, reasonably get the related cost. And then there's the principles framework deals with how you collect monies, and in some cases you collect it all up front. In some cases, you could get it at 50% at the agreement stage and 50% at the building permit stage, and council can enter into agreement. So I'll illustrate how we're dealing with our first one in a moment here. If you go to the next slide. And then the other thing, some of the final things the principles document does is it gives you guidance on it, establishing funds for all of these capital related infrastructures that you're trying to recover, and it can give you guidance on dealing with residential versus non-residential. So next slide. So as I mentioned, we did a background study on all of this. It focused on the extension of Twin Oaks. It outlined how we did the calculations based on the principles framework, and it outlined a process for us to how we would recover. And if you go to the next slide, so this provides a summary of the infrastructure by type. So you can see the road, water, and sanitary costs, and it totals about 2.1 million. And so that's what our our development charge recoverable is. And this is part of the bylaw. And if you go through to the next slide, this shows you the area. And so in this context, the local cost sharing, we took a frontage approach on this. And other areas, when you get up into more different types of infrastructure that focus more on an area based, you get into area specific. But in this case, we're recovering our costs based on frontage. So you can see the different properties that we're recovering from and their frontage. If you go to the next slide, this sort of gives you a breakdown of the costs. And as I mentioned earlier, and as Gary talked about, sometimes you have to deduct costs that are provided by grants. And so in this case, what's interesting, the province gave us money that got put in a reserve, and it goes towards their project or their portion of their frontage costs. So you can see 816,000 there. So that's taken off the overall cost of the 2.1 million, and what we're left with recovering is 1.3. And then there's a formula based on everyone's total frontage. You can see the cost that everyone owes on the table below. So if you go to the next slide, the development charge bylaw, and it's online, but it contains all the charge areas and the calculations, and it requires us to enter into development charge agreements as part of cost recovery. And as I mentioned earlier, we do indexing. We'll do that once a year. And Gary, I'm trying to remember, it's based on the construction. What's the source of that, the indexing?
There's a StatsCan construction cost index, and so there's a Moncton series for it, which would be probably representative of the area. And what it does is it tracks tender prices, and it's a good index because a lot of capital cost index only track labor costs and materials, where this one actually tracks tender prices, which means if we go into a economic downturn, that index slows down or maybe even goes negative because people are cutting their the tender pricing. And in more robust times, it may expand a little bit faster. So it's a good, a reasonably good index to use from year to year.
So with our folks from the province, for example, like Paul Jordan's provincial planning, we'll be submitting an annual amendment just to keep our index costs up to date. So there might be an easier way to deal with that in the future, but it may require some adjustments to the provincial regulations. So if we go to the next slide, this is our first development charge agreement. You can see this is a developer. Cordova Realty owns this land. It's about 13 acres. And if you remember the table that I showed earlier, it showed that they owed $697,853. So if you go to the next slide, they're very excited to be developing. And what's interesting, I mentioned, you know, we are anticipating that this area would develop once we completed the collector roadway. And recently, the property owners have went through a rezoning process to do a mixed-use development. And they're building a number of buildings. A couple of them are commercial mixed use and the rest are residential. And this is going forward, and we are in the process of finalizing the development charge agreement with them. If you go to the next slide, this sort of highlights a little bit more information on the concept. You can see what's being planned here. And if you go to the next slide, so this is about a $75 to $100 million development. It's creating 8 buildings that will create approximately 519 residential units on this property. And we expect it probably will take 5 to 10 years to build out. But in terms of our development charge agreement, basically in terms of repayment, 50% of the costs of that $697,000 will be paid upfront prior to the first building. And my understanding is they're designing and hoping to get a building permit next spring for the first building. And then the remaining 50% will be collected at each building permit stage for the remaining 7 buildings. And it works out to approximately $50,000 for each remaining building. And so this is all detailed in agreement. It will be registered against the title. And so far, I'm really pleased with how easy this is working. And some of our team, Andrew and Josh Davies, have been working with a number of other city departments, engineering, finance, legal department, building inspection, to put together sort of an interdepartmental sort of standing operating procedure for how we're going to track these payments inside an information system, how we're going to do annual reports, how we're going to, administer the bylaw, and everything from doing the agreement to tracking payments and dealing with various scenarios. So if you go to the next slide, just in terms of summary, some important takeaways. The new legislation's key to supporting infrastructure planning in New Brunswick. It's important to have a really good public consultation process and dialogue with your property owners and development community. Professional expertise can also function as an intermediary facilitator. It's interesting to note, once we've done this first bylaw, we're already getting major requests to do more. However, not everyone is going to be as enthusiastic as our first area to get on board with development charges. It'll be controversial, and you really need experts like the Watson and Associates to get you through that process. And then the establishing charge areas and calculations requires consistent methodology. So that's where your principles framework, policy framework are key. And with the Moncton context, we've done that work. So next time we go to amend the bylaw, we're only really dealing with the schedules, the new areas, and the background work associated with those. We don't have to redo the whole bylaw because the rest of it's fairly sound and doesn't need to be dealt with. And you want to set up a bylaw to be flexible for the addition of different types of charge areas. And that's our bylaw set up, that we can, add more local cost sharing charge areas or area specific, or one day we may want to do a citywide development charge. Could be for transit facilities. Maybe there's some kind of active transportation plan across the city, and we want to allocate the costs across the city. And then part of the established areas will you'll pay for it through capital cost of the city, and then the growth areas will pay their costs for those things. And then finally, it's a great tool to assist with growth management and implementation of your neighborhood plans and other type of municipal plan objectives. So with that, thank you. Andrew, I'll turn it back to you.
So we don't have any questions lined up in the queue again. I'll take that as a sign that the topic was so thoroughly covered by our presenters today. So before clearing up, I'd like to thank Gary and Bill, for presenting. I'd also like to thank the other members of the CPL committee for helping put this session together. So there's a lot of other work happening behind the scenes to make these sessions happen. So a reminder that the session was recorded as well. So my understanding is that it will be available under the member services section of the API website. But if you'd like to follow up and contact me directly, and I can try to answer your questions or redirect them to Bill or Gary. My email is andrew.smith@moncton.ca. That's andrew.smith@moncton.ca. So thank you very much, everyone, for attending, and take care. Bye.
Take care.